I'm Emily Boothroyd, and I'm a financial planning specialist with Westport Resources in Westport, Connecticut. Divorce is never a simple issue. It's an emotionally charged time, and it's really important that during this time you surround yourself with a good team of professionals and you really understand the issues. Today I want to talk to you about 3 tips every smart woman should know when she's considering getting a divorce. Although a 50-50 split may seem like a good idea, it's important to understand that not all assets are created equal. How an asset is taxed and when you can take distributions out are 2 crucial aspects to understanding the division of assets with your settlement agreement. Let's take a look at the difference between retirement accounts and individual taxable accounts when it comes to the taxation and the distribution of assets. Traditional retirement accounts, and I'm thinking about a traditional IRA, a 401k, or a 403b, are funded on a pre-tax basis. That means that you don't pay any taxes going in, but you do pay taxes going out. So any and all distributions that you're taking out of a traditional retirement account are taxed at your ordinary income tax level. Individual investment accounts, on the other hand, are typically funded with after-tax dollars. So I'm thinking assets that are from your salary, your W-2 income. With these assets, the distributions that you're taking out of them for your regular living expenses are only taxed on the growth. So just remember, it's only the growth on these assets that's being taxed here. This is way different than a traditional retirement account. If you'll remember, it's 100% of the assets that you take out of the traditional retirement account that you're being taxed on. So it's the difference between being taxed at your ordinary income tax rate for retirement accounts on all of the distributions that you take and just being taxed on the growth for the individual investment accounts. Another really important aspect to the division of assets is when you can take the money out. With traditional retirement accounts, you typically can't take any assets out until you turn 59 and a half. That's unless you qualify for some sort of exception that the IRS will give you. If you take assets out before you turn 59 and a half from your traditional retirement account and you don't qualify for one of the exceptions, then you're looking at paying tax at your ordinary income tax rate, plus possibly a 10% penalty. If you take assets out of your individual investment account that was funded with the post-tax dollars, you're really only paying tax on the growth. So it's a lot easier to take assets out of your individual investment account than it is to take out of your traditional retirement account. It's important that whenever you're presented with a settlement agreement, you speak with your attorney, your financial planner, or your certified divorce financial analyst to really understand the implications of what the division of assets means to you. Just remember, not all assets are created equal, so consult your team and really think before saying yes. Please join us for the next video, where we discuss how holding on to your home can be detrimental to your financial health.